So I'm Bill Deichler. I'm currently a trustee of my municipal city's police pension plan. So I have a great affinity, and just recently now formally chief investment officer for a single family office based in Orlando, Florida.
Bill, what type of trustee? I missed that.
I am a trustee for a police pension fund. So I'm on the board there. We have no staff, so essentially all the investment decisions, all the administration of the pension plan is on the shoulders of myself and my four other fellow trustees. Two of whom are cops, two of whom are mayoral appointments, and I have a consultant. So it's a very challenging environment. But Mark has been running a questionnaire that we sort of impromptu kind of put together way back at the beginning of the Ukraine war, and just wanting to gauge the opinions and the thoughts of the community that's out here. So with great apologies that you all don't have the slides in front of you, I will try to verbalize it and do the best I can. But I think it presents somewhat of an interesting consensus, and the path by which we've gotten, to these numbers is also interesting. So there are a couple of questions. One, asking about the Fed funds rate. Where do you think it's going to be? And in a way, it suffers from the time duration factor, but currently the consensus is at about 3%. So this would be pretty much kind of at the end of the year. What are people thinking about? And it's 3% plus slightly. So the weighted average of the responses was a little bit higher because one of the options was higher than 3% or lower than 3%. And I think, kind of where we are now, it's still a roll of the dice as far as where they're actually going to wind up. And, some of the comments to the Fed governors as of late were backing down from the 100 basis point possibility for the next hike. Even this morning, bank credit analysts came out, no hikes in 2023, possible easing. So, kind of interesting there. Core inflation, as you know, the prints.
Does anybody have a strong opinion on fund rates?
All right, so you can go right on.
All right, carry on.
Yep. So the latest prints on core inflation was the print on core was 5.9. The headline that everybody fell over on was 9.1%. So which is huge. That was June. The options in the survey sort of baselined on the May numbers, which were at 6.5. And interestingly enough, even though some of the responses that came in very recently were still at 6.5 is a reasonable expectation. So I think that going forward, people admit that, yeah, it's pretty bad right now, but likely to be tapering off a little bit into the future. Another very interesting one, price. So last time, Stephen raised the excellent question, is that a headline number or a core number? So in this survey, we separated out what are the thoughts on oil price and food price separately. And interesting, survey says $100 oil, $9 gas, but with a bias towards the low side. So in terms of looking at all the responses, there were some people that were thinking that it's actually come out a little bit later. I didn't check what it was today, but interesting. There seems to be some easing on that. Food prices roughly the same.
I think the curve is 70 now.
Okay, thank you. So it's changing by the moment. GDP, interesting here too. Previously, the responses were, yeah, absolutely, we're going to have a recession. That was where the main consensus was. Now they're saying just about 0% growth. So not necessarily a recession, but certainly subdued. In terms of how people are responding to that for the portfolios, we saw a change from a split between strategic movements and tactical movements to now the consensus is much more tactical. So people are making much more shorter term movements with their portfolio. So now there's a split evenly between, are we going public or are we going more privates? And that was pretty much evenly there. Then we asked, like, what are the macro issues that are keeping you up at night? I think everyone could agree there's like a very long laundry list, and we did get that. Just to enumerate, just so that you all can see, rising rates, the Fed, probably front and center, food inflation, obviously the energy supply chain, continuing war, then some of the lesser responses, credit bubble, volatility, the decrease in VC funding was noted as a potential concern, and then obviously crypto markets. So, where are the attractive opportunities that people were thinking about? And some of the more frequently noted ones were health, agriculture, which I thought was interesting that those were kind of up front, fintech, metals, including precious metals, real assets. It kind of went down, beaten down sectors. Interesting enough, there were some thoughts. I was talking to a guy the other day about distressed Canadian real estate, which is interesting. Nobody ever thinks about distressed Canadian real estate. It's like it's always overpriced. How can there be distress? That's one. In terms of where people were decreasing their exposure, financial services, tech, traditional fixed income makes sense. Although we had Greg from Carillon, the CIO there, who was going long treasuries. So I hope he's early, and it was a good call. But some interesting differences. Some people were looking at private credit. Other people are getting out of private credit, stocks, EM, and of course, crypto, NFTs.
So on Greg, you also went long. You went long China equities early too.
Well, yeah, that's
not really. He thinking of that one.
yeah. I was going to say he probably timed that one perfectly. We'll see if it lasts.
Yeah,
Let's see if it lasts.
Brett.
Oh, thank you.
Brilliant.
I know. Fred, if you're listening, my apologies.
That's right.
So at any rate, I have a chart on here that shows the allocations that people submitted in terms of actually where they're allocating across, equity, fixed income, PE, private credit. Since you all can't see it, it's probably not that worthwhile to go through that. The only thing that I will say about the interesting thing in the data is that some people were extremely barbell. I think there was one response that was like almost 50% PE and 50% gold. So, or I think it was gold cash. So we'll see. I have a feeling it's probably more cash than gold. Nonetheless, that was interesting. So, the question now, of course, is kind of like, where are we as far as the new normal? And that's been sort of the theme of the last couple of presentations that I've had on this is, where's the equilibrium? Are we there yet? Are we still vacillating a lot? And in terms of inflation, even though the numbers are high, so we'll talk about inflation for just a couple more minutes. The CPI core was off 50 basis points from the last print. I think that was right. So the fact that we had just even a little bit of a tap down, I think was pretty interesting. If you look at the PPI numbers, the headline PPI is a nosebleed 14.2%, which is like crazy. Over going back to 08, which is as far that I have the chart here, it is definitely well above peak there. But if you strip out food and energy from that, it's a much more modest 5.2%. So it's producer price at 5.2%, essentially on the core side. So that's interesting. The other interesting thing, and again, it kind of comes through a little bit stronger in the slides, but just to paint the picture for you, commodities are off as much as 20% off their peaks in June. So most of the commodities peak in June, and almost across the board, certainly the sub-indices for Bloomberg, for the Bloomberg index of agriculture, energy, and precious metals are all off 20% since June. We're June 19th or July 19th. I've got 9 charts on this next one, but everything, you look across all commodity sectors, everything is down. except for feeder cattle. That's one that's still up. In terms of inventory, so, thinking about other ancillary data that could give us hints about inflation. The inventory to sales ratio is actually building right now, and it's been building for a couple of weeks. So the question that begs to me is that if inventories are building, where's the shortage? So I'll just sort of leave that one out there. So I think we've got some interesting data on the inflation side. Clearly, it's not great, but there are perhaps some canaries in the coal mine that are starting to chirp at us. We hope. They're kind of pivoting over to where do we think the Fed is going to go. Once again, I told you this morning, BCA came out with their headline of possibly no rate hikes and possible easing into 2023. There's a new metric that I found, and welcome to the world of social media. The guy who posts this on Twitter, his handle is the Happy Hawaiian. So, okay, but it's very interesting in the sense that what he does is he takes the average of the current Fed funds rate and the 5-year yield, and you multiply that by the national debt. So you have a metric, and put this link down just right here, and I'll try to describe it for you. In looking back all the way back into the 1980s, you have a graph that has a cone on it, and there's an oscillate, and that metric oscillates back and forth, and it hits these data, and it hits these boundaries on the cone. The fit is pretty good. And whenever the metric hits the top end of the boundary, that has usually been when the Fed begins to ease. And right now, we are right at that upper boundary. So the implication of that is that if we do see some significant rate hikes for this, this coming period and next into the fall, it's very likely that the Fed will once again overshoot. And the potential for recession is higher because they're overshooting. The other thing that I don't have in the slides here, but I think is a good data point to know, is that
Make a point. We can send your presentation to everybody. You have it by email.
cool. So it's all there. Excellent. Again, this one's not in the slides either. But global monetary tightening, the global money supply has been tightening for months. And if you think about that, clearly funds are being pulled out of the system. So once again, you've got more fuel for a potential recession. The current yield curve, kind of going back to my slide, current yield curve, we've got an inversion from the 210 spread. Last time, when I printed this, was 20 basis points. To give you some perspective on that, the last time that we saw that level of inversion was back in 2001. It is worse than where it was in the Great Financial Crisis, leading up to the Great Financial Crisis. Okay, for those of you who just tuned in, I'm on slide 12. The other thing is that if you look at the return or the distribution of that 210 spread, we are to the left. So this is a pretty rare event that we're experiencing right now with regard to the inversion. The other thing is that, again, I've mentioned this before, but could we possibly be in a technical recession right now? It certainly looks that way. The Atlanta Fed now model has been steadily declining. The positive contributions to GDP have been declining over the last number of months. And the negative factors have been increasing. So right now it's showing about minus 1.2, but that does tend, because it's daily, it does tend to vary around. Investor sentiment is just crashing. The University of Michigan survey is clearly in the cellar. Last number on that was 71. The last time we had a number in the 70s was back in the GFC, and on their series, which goes back to 1992, never there before. So consumer sentiment is like way down. Also, real wages are also shrinking and have been taking a nosedive over the last couple of months as well. So, there's some things that are tough out there. One of the counterpoints on my next slide is that 12-month forward EPS numbers have been holding up reasonably well, and that has been a very positive aspect of things. Also, the retail sales number that we got on Friday was very strong, across the board, and I think that the market responded to that accordingly. So there are some lights out there. Again, we're vacillating around kind of where is this new equilibrium that's coming, and we're probably hovering, maybe somewhere in there. But one sobering final thought that I want to leave with you all is the energy picture. So energy is now 16% of world GDP. So what does that mean? What it means is that only 84% of the world's GDP is available for meaningful production. And the more that energy increases, because I thought this is sort of not my ownership here, but I thought it was an interesting thought that energy drives GDP. And the lower your share of GDP the energy has, i.e. the cheaper energy is, the more productive you can be. So the higher the cost of energy, and you can think about this both in dollar terms and local currency terms, but because oil is primarily traded in dollars, it's just getting ridiculously expensive if you're a non-dollar entity. So energy is.
So what has it been historically?
Okay, so the historical trend from generally speaking for the last 20, for roughly the last 20 years, it's been about 5% or less. So now we're seeing it 3 times what it has been before. The only other time that we've hit this kind of a peak was back in right around the GFC, right around there. And then before, kind of going way back into the early part of the 2000s.
And what percentage is food globally?
Good question. Honestly, don't know. But thank you for. I think that's important because it's the same type of deal.
I think it runs between 10 and 20% combined food and energy globally, and the US will be a little lower.
Okay. So if we want to eyeball that, then let's just say maybe it's during the better days, it was split half and half.
It's also advanced versus developed. The developing economy would be closer to 20% level. Right. And now it's probably elevated from that.
Yeah. So to your point, you can see that the necessities of life are beginning to crowd out the opportunity for the advancement of the quality. Let's see. So that's a sobering thought, and it does present the notion of potentially a vicious circle that's happening, because if things continue to spiral out and we have energy that continues to increase in price, then it just takes that much more away from the productive economy, and it makes it that much more difficult, for non-dollar nations, and particularly all alternative energy sources need fossil fuels to produce them or to mine them. So the more that costs, your cost of production goes up, means alternative energy goes up, and it may not necessarily be the panacea that we hope for. At the very least, it will be more difficult and less economic in terms of its implementation for the energy mix. So, not to close on such a dour note, because, but I think that's something that's pretty important to watch. And I think just final comment, I mentioned this last time, what all this means: higher risk premiums for everything. So we're going to be demanding more from all of our investments because things are more crazy. We talked about shifts, active over passive, sectors over industries, or I'm sorry, sectors, industries over markets, relative concentration versus broad diversification. And I wanted to add one more, seeking non-correlation. So things that aren't correlated to these big systematic factors that are out there, but perhaps more idiosyncratic.
So did anyone raise the dollar strength as an issue? Survey?
Yeah, I think that's a good point, and I don't believe that they did.
Maybe
There's
there's
a-
a
there's a
more specific question on that next point.
Yeah. So,
Yeah, all right, so.
I'm sure.
Sure.
My name is Ira from just a fact relating to the interplay of energy and food. The USDA says for every 100% increase in the cost of fuel, food prices rise by 20 to 28%. So you see the devastating impact of that.
yeah, more evidence of the vicious circle, that's what it's.
So we laid out a lot of factors driving the economies. Any comments, questions? Might feel the hundreds down.
Yeah.
Move around.
So I got one. I wonder, yeah, thanks. Oh, yeah, hi, I'm Henry. Bill, this is amazing, as always, between you and Steven. I'm not sure who makes my perspectives more. But if you have
awards at the end of the year.
do we? All right.
I'm gonna hold it up for Steve.
There's a couple of things that kind of came together in my brain, which were, as CPI is going up and PPI more, and food and fuel more so, and thinking about the percentage of GDP that is food and fuel, and the combination of those things, it strikes me that there are people that are even more impacted by this. And it's not the people that are sitting in this room. And how are we thinking about the impact on the global economy with those factors coming together? And even in the US here, with the haves and the have-nots.
It's like such an important question. You can think about it as one example of what's going on in Sri Lanka, and the other countries, Middle East, North Africa, that are much more severely impacted, not only by increasing costs, which are somewhat caused by the war in Ukraine, the lack of things there. If this thing continues, it's just going to get worse. And so our hope is that we can mitigate some of these aspects that are coming along. There are initiatives that are at work right now with regard to securing safe passage for Ukrainian grain shipments through the Baltic right now. If that happens, that's going to start easing things up. I think if the forward curve on oil, it's actually dipping back down into the 70s. And I was at a conference in Europe a couple of months ago, where one guy at that particular point in time in May made a very bold statement that he expected oil to be at 60 by the end of the year. I'd just say that's going to help. My one little anecdote, and this is actually good news and bad news. Gas at Costco was $3.99 last week when I filled up. So it was good that it was $3.99, not $4.99, but it was so bad news that it was $3.99. Somebody told me yesterday, I think they found it for like $3.79, $3.40. So we have the potential, for things kind of easing up a little bit.
So we have an energy trader here. One of the hats you wear, you can tell us how you're seeing the market.
Well, there's a supply problem, but it takes a few years for supply issues to. I'm talking about the oil markets, just the supply issues to kind of shake out. So essentially, the oil majors and the independents are not willing because they've learned the lessons from the past crises, and now they're going to return back to shareholders. So there is they're being very conservative, and that's going to change for sure. But the question is when. And for now, I see that There's gonna be additional, catalyst in the market, there's gonna be the sanctions on Russian oil. I believe that we're talking about December, let's see. There's also the gas problem with Russia in Europe, and right now it's summer, so everybody is buying. I just visited my friends in the Netherlands. Everybody's stocking up on coal and wood, so people are kind of anticipating what's going to happen, and obviously that catalyst will be the drivers for gas markets.
Today, Gazprom said they have force majeure in these areas are going to try to provide some of that gas.
So have you guys thought about the global impact for the fact that 40% of Korea and fertilizer comes out of Ukraine and Russia, and the global impact that having on?
Yes, that that continues to be an issue. I think it is, even though it's impacted some of the more developed countries, some of the lesser developed countries have been feeling that much worse.
What's the estimate of how many people will starve this winter?
That one I don't know. That one I don't know. But I think as a rhetorical question, it's important to ponder.
I heard it's a lot.
I think you asked a question, and how is this impacting American spots of America that already nutritional access gaps? Does anybody have any insights on how this?
I have the number of food banks are being overwhelmed. I'm not sure the number of food banks since the start of the pandemic have been overwhelmed, and it's getting worse now that they will catch up, and more and more people are requiring it. So it's become a major issue that's not getting enough press.
So we're still in this free flow technically the first panel is this, so we're reflecting on strategy. So let's just make it a round table until about 9:45. And then we're gonna have first the female investors and founders and funds, and then we're gonna have new models for collaborating. But there's new people here. Kathy, might put you on the spot. Introduce yourself. As she's about to
Hi, Kathy Graves. I'm a trustee of the City of New Haven's Public Employees Retirement Fund.
And do you want to share how's the pension fund looking at the landscape today? A few comments on it.
I think we're pretty well situated with our actual allocation at this time. We may be looking to do some more private equity. However, we have quite a diversified portfolio that we're pretty comfortable with. Our consultants started anticipating this about a year ago. We started moving things around, so we're pretty comfortable right now.
Yeah, probably. This way I can introduction. So I'm a trustee on a small municipal police pension fund also, and I can tell you that the vast majority of municipal pension funds in Florida, not the big Florida state, are generally pretty 60-40-ish. And one of the consultants who works with many of them is sort of like, we're going to see this out. And we're just going to gut it out, and we're going to stay in there, and we're dollar cost averaging, we're rebalancing, back to our targets, as necessary, and things like that. And so they're in an important segment of institutional investing. There is this mindset that we're just going to stay, we're going to stick to our knitting, we're going to stay according to our strategic goals, and we'll rebalance relative to the markets. So as opposed to some family offices that have been very tactical, and also, other larger, more nimble plans and endowments that perhaps have made adjustments to their portfolios. There's still a lot of money out there that is kind of staying the course.
Anyone else want to weigh in on this? Okay, Eric. There's a lot of hats, but your hats are like 1.1 billion hat and then 300 or 640 million hat. So Eric in the city of Stanford, and so going back to that point, when, you know, you're looking at, you know, all of us pay tax dollars. This goes into fund the pension plans. There's a new variable now. Every community, small, big, has to do capital projects, and they're going out to bond. And the interest rates from where, you know, they're going to be raising their money now, 3.5% to 4% as rates continue to rise. That's going to be sucking out money from other parts of your community's budget. But it's going to be money for food, people who won't, you don't necessarily know who needs food. You know, it's not something, hey, I'm in that situation. So, right, food banks are critical. More money to be taken away from that, should be on that at this point. And they put that balance up, where you put the money as government entities and kind of balance that. So it's another thing to look at. And going back to the allocations, you know, public pension plans are slow. Their board governances are not nimble. It's not quarterly meetings, it's not monthly meetings. So unlike a family office where you put or private portfolio, you can be very technical, move very quickly. These public pension plans are like big freighters. They move slow, and to turn them around, it takes time. And at times they'll be behind the curve, other times, you know, they might be ahead of the curve. So it's something to keep in mind.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.